2010, SAMHI is a prominent branded hotel ownership and asset management platform in India. It has an institutional ownership model, experienced leadership, and professional management team. A portfolio of 31 operating hotels comprising of 4,801 keys and has a diverse geographic presence in 13 cities. It has adopted an acquisition-led strategy. It's underpinned by its track record of acquiring and successfully turning around hotels to grow its business. It operates under established and well-recognized hotel operators globally, such as Courtyard by Marriott, Sheraton, Hyatt Regency, Hyatt Place, Fairfield by Marriott, Four Points by Sheraton, and Holiday Inn Express. Please allow me to take you through some key specifics of the issuance. The total IPO size is 1,370 crores. The way it's broken up is there's a fresh issue of 1,200 crores and an offer for sale for 13.5 million shares. And if I total it at the top end of the price band, it's 170 crores. The anchor opening is on the 13th of September. The bid open to the public is 14th and closure on the 18th of September. The estimated listing date is by the 27th of September, which is a Tuesday of the week after. We've also closed a secondary pre-IPO placement of 130 crores at a price of 126, which is the top end of our price band, taken up by TIMF Holdings, Nuvama Crossover Fund, and Madhusudan Kela. I look forward to your support for this issuance. I'll now welcome Mr. Ashish Chakanwal to take us through his journey.
For making time to come here. Apologies for this delay. It's my pleasure to introduce you to SAMHI Hotels. I've already given a quick background around the business. In summary, we are the third largest owner of hotel rooms in India, 31 hotels, 4,800 rooms. We're present across 13 cities. Actually, here you mentioned 12, but we have added one more city through the acquisition. Very good diversification of assets across India. So if you look at the map on the slides here, you would see that we are present across all key consumption centers. The price points that our hotel represent are also fairly diverse. We are from mid-scale to upscale, upper upscale. So a pretty good mix of hotels across price points and across key cities in India. Our key business model has been acquisition and turnaround. We feel that there is a huge opportunity for identifying an acquisition of underperforming, undermanaged hotels. We have built a programmatic approach to acquire such hotels and then effectuate a turnaround through product improvement, rebranding, and a really high quality asset management. Approximately, if you see, we have 4,800 rooms today. We have only built 665 rooms. Rest, all of the inventory has been added through an acquisition and turnaround led strategy. Now, the advantage is not only has it allowed us to grow fast, but it has also ensured that our cost per room or capex per room has been at a significant discount to market averages. The acquisition-led strategy, the other key advantage of that also is the fact that we can add inventory at a rapid pace. In a development-led model, you can only build that many hotels at any given point of time, whereas in an acquisition-led strategy, you can really build pace fairly quickly. And as we saw on the previous slide, you don't have to necessarily overpay for that growth. One of the important parts of our business model is really leveraging power of strong global hotel brands. As you know, we work across some of the most well-known hotel brands globally, but for the Fairfield by Marriott and Holiday Inn Express, we have a very large share of those hotels in the Indian market. So as of the 31st March 2023, we owned about 43% of all Fairfield by Marriott hotels in India and about 71% of all Holiday Inn Express hotels in India. And these two brands are fairly well recognized in the mid-scale space. This is just a quick summary of the various segments we operate in. In the upper upscale, we have 5 hotels represented by really well-known brands like the Hyatt Regency in Pune, the Sheraton in Hyderabad, Renaissance by Marriott in Ahmedabad, the Courtyard by Marriott in Bangalore, and the Hyatt Place in Gurgaon. In the upper mid-scale, we have about 15 hotels, so we have a very large presence in this segment, and the two dominant brands in this price point or in this segment would be Fairfield by Marriott and Four Points by Sheraton. And then in the mid-scale space, we own, and currently they're operating 11 hotels with about 1,500 rooms, and this particular segment is all Holiday Inn Express hotels. So really a good diversity of price points and segments. I think one of the most important things that we've realized over the last decade building this company was how India has grown and evolved as an economic powerhouse. And this slide perhaps is the best example of that. If you look at the size of the office market in India and some of the key Indian cities relative to the regional and global peers, you realize Indian cities have now come to a point where they're larger in economic activity than some of the really strong regional and global peers. What we have done over the last decade is ensure that our capital allocation and asset identification follows this growth, and therefore almost 80% of our revenues today come from markets which contribute 90% to India's office space and about 70% of total India's aviation market. As we build our business, we've also built operational tools to ensure that we manage our business adequately and don't lose efficiencies. One of those tools is SAMHI Intel. It's a data analytics tool. It helps us really see a cross-section of performance across our hotels through price points, cities, and segments. It helps us identify repeatable trends. It's also a great tool for us to understand potential acquisition opportunities for future. Similarly, we have built a very strong proprietary building management tool that we call SAM Connect. I think one of the important, and this has been spoken about on multiple platforms, about where the sector is headed. And I think we really have 2 or 3 important data points in the sector that we rely a lot on and that we think both SAMHI and several of our peers will benefit from. The first is that the supply environment in India is now much more stable than it used to be historically. So from a very small base in 2008, the supply has now grown to about 150,000 rooms in India. And therefore, on that larger base, incremental new supply has lesser impact or volatility as we saw in the decade between 2008 and 2018. The second important data point is the penetration of hotel rooms to office space. And given the fact that we have hotels and business locations, we'll tend to be biased towards that narrative, right? But if you look at the key cities in India, the penetration of hotel rooms to per million square feet of office space continues to be really suboptimal. And some of the strong performance you're seeing come through our peers is on account of the fact that hotel industry has not penetrated the demand adequately. And on top of that, you see the new supply. We actually seeing the supply is continuously slowing down. So while the demand has grown anywhere between 8% to 12%, 13%, if you look at airline, office space, travel and tourism, the supply is barely growing in the range of 2 to 6%. And that's really 101 of any sector or any economy, that when demand outgrows supply, you clearly get a very strong and stable operating environment to operate your business. The other important thing which people often tend to ignore, when you talk about India, they talk about Bangalore, Hyderabad, or Pune, or Gurgaon. And the moment you talk about these cities, invariably the first word that comes to your mind is it's a BPO, it's a KPO, it's an outsourcing, or an IT park, so to say. But what we've seen happen, and this data on sources of employment, what we've seen happen is India has evolved from being an IT park to a business park, from a business park to a real economy. And I think that transformation of India and Indian cities is really helping the hotel sector, because in the end, we get our consumers from where the employment is coming from. And if you see today in 2022 to the next 3 years, many more sectors are becoming prominent source of employers. And I think that broadening of the economic activity is another key factor which will influence the performance of hotel industry in India. As Neha introduced us, and as I introduced ourselves, 12 years, third largest owner of hotel rooms in India. So our growth has been really strong over the last decade or so. The good thing is that now we have a lot of internal growth within the company, so we don't need to necessarily look outwards. A fair bit of growth is captured within the company. Really 4 levers. One is we have recently made an acquisition of a portfolio, ACIC portfolio. Full details are available in RHP. We think integration of that portfolio to SAMHI will create a really good future outcome. We are also entering new markets like Calcutta and in the near future Mumbai. Then we have, with the deleveraging from the IPO proceeds, we intend using the future cash being generated by the business in a programmatic deployment. And last but not the least, the fact that our existing portfolio is extremely well located to leverage the market environment. This is just a snapshot of the ACIC portfolio, very strong portfolio, 6 operating hotels, a piece of land in Navi Mumbai. We're very excited about integrating this portfolio with that of ours. In terms of how we break up the future growth, if you look at SAMHI today, it's 4,800 operating rooms. In the near future, you will see about 920 rooms of the 4,800 rooms going through a renovation and rebranding. And on top of that, we'll add about 600 rooms to our portfolio. So the total inventory in SAMHI would be about 5,400 rooms, and we do not really need to make any acquisition or go outside of the company to deliver that growth. So I think in the near term, next few quarters, the company's growth is all within the business, is all organic, and in the longer term, we feel the opportunities for programmatic deployment of a free cash remains very, very attractive. As you know, this company does not have an identifiable promoter, but what it has is a very stable and aligned management team. The company was started in 2011. It effectively went into operations end of 2011, 2012. So it's an 11-year-old company. And if you can see the KMPs on this chart, the management has stayed with the company over the last decade, extremely well aligned, both in terms of the purpose and also in terms of the financial alignment. A company without an identifiable promoter also needs a very, very strong board, and we've seen some really well-run board-driven companies. So very strong, well-experienced board is what we present. The company has grown really well. So if you see the period between FY20 and FY23, of course FY21 and FY20 were heavily influenced by pandemic. We've seen our revenue grow from about 627 crores to about 964 crores. So we've seen a really good growth in revenues. Consequently, we've also seen the EBITDA expand from 172 crores to about 311 crores. I'm comparing FY20 to FY23. I think that comparison is more relevant than comparing it to FY21 or FY22 because those two fiscal years were heavily impacted by the pandemic. Interestingly, even though the full year has been reported at 311 crores of EBITDA, what's even more encouraging is the fact that we are seeing quarter-on-quarter growth in the key performance indicators. So the capacity utilization now is well established in, I would say, mid-70s. The last quarter was 74%. The whole year was about 72, 73%. But even more encouraging in the fact that we've seen quarter-on-quarter growth on average room rates. Right? And I think this is a trend that we are not seeing just across the portfolio, but at each price point. So even in the upscale hotels, we've seen the rates grow from 6,800 rupees to 9,400 rupees quarter-on-quarter. In the mid-scale space, we've seen it grow from 44 to 57. And then again 3,000 to 3,600 rupees. Therefore, we feel that whatever demand-supply equilibrium we are talking about, the strength of the markets we operate in, the broader strength of the sector is well displayed in the key performance indicators that we've seen over the last 4 quarters. In terms of overall performance, I think I've articulated it before. The company has moved its top line from 627 crores to 964 crores, period for FY20, FY23. We have seen our EBITDA expand reasonably well during that period of time. We have high, the IPO proceeds of 1,200 crores are largely directed towards deleveraging the balance sheet. And with that, we also expect to see significant reduction in our finance cost. So that really sets the path for the company's profitability in future. But that's really the summary of the business that we wanted to present you today. And we are happy to take any questions that you may have now. Thank you.